Hello everybody, Luke Groman, FFTT. Hope everybody is well and has had a great weekend. Busy weekend of baseball and actually my oldest son's birthday as well. So had a lot of fun. So let me, with that preamble, jump right into it. First question comes from David. Can you give a 2-minute articulation of your electric vehicle / peak cheap oil hypothesis? Yeah, I think it's pretty straightforward. So for peak cheap oil, I think is a key way to phrase it, and really the case is the biggest incremental increase in oil supplies since 2005, 6, 7, 8, pick your date, has been from U.S. shale globally. And U.S. shale producers over the last 5, 6, 7 years have increasingly high-graded their wells, which means they've produced their most attractive acreage to maximize cash flows, particularly during the 2014 to 2016 downturn. And now, having high-graded a lot of their best acreage, they are now having a harder time overcoming depletion rates that have always been around 3 to 5% per month in that industry, depending on the prior 2 years' worth of production. So the faster they ramp production, the higher the depletion rate goes initially, and when they cut production, the depletion rate actually falls, which is a little counterintuitive, but that's just how the business works. So right now, they've high-graded the wells, a lot of the best acreage, and you've got a depletion rate at the 4 biggest shale fields that are right now running around 60% per year, 5% per month. So at the same time, a disproportionate percentage of conventional oil supplies come from a relatively few major oil fields that are now, when you look at the list of supergiant oil fields, as Matt Simmons called them almost 20 years ago, they are now all almost 55, somewhere between 55 and 100 years old. And all of these fields, almost all oil fields, have followed some version of a bell curve. You ramp production, you peak, and then you start see production fall on the other side. So people forgot about peak cheap oil because shale came in. Shale now looks like it's going to be harder and harder, more expensive to keep growth flat or grow supplies. Excuse me. And then I think something that has really hit me in the last 2-3 months as a really big signpost potentially has been Audi, who's owned by Volkswagen, the single biggest corporation in Germany and the biggest employer in Germany. GM, last week Mercedes-Benz. These companies that have 60 to 80 years plus invested into internal combustion engine supply chains, tens if not hundreds of billions of dollars invested into internal combustion supply chains. And they're all now talking about taking significant portions or all of their production to electric vehicles within 5 years. And so to me, it just doesn't make sense. It suggests there's 2 options. Number one, these companies are willing to bet their companies on electric vehicles, completely reorganize their massive supply chains on what amounts to basically betting the company on virtue signaling. That's one option. Or the other option is there is a supply issue coming, and these companies, by virtue of being as big as they are, have been tapped on the shoulders by their governments saying, hey, start reorganizing your supply chains. This is coming. Don't get caught by surprise. And to me, it strains credulity that the CEO of a major automaker would bet his company on virtue signaling. I just don't think that's how executives work. So with that said, to me, I think we're about to see peak cheap oil come back as a major theme in a major way in coming quarters and years. I think it's really good for oil prices. I think it's really good for broad commodities. I think it's really good for metals and particularly and industrials within the electric vehicle supply chain. So that is I took a little bit longer than 2 minutes, but I think it's a pretty important thing to start paying an increased amount of attention to, particularly since oil remains pretty hated. Second question from Pete. At what point is the world going to realize that we have a fossil fuels energy return on invested energy? In other words, the number of oil barrels you have to invest to get a barrel of oil back. That number 100 years ago, call it, was you'd get 100 barrels back for every barrel you invested, so to speak. And that number has been shrinking over time, continues to shrink. That's an ERO, energy return on invested energy problem, or EROIE problem. And then when that happens, how long do you expect dollar reserve currency, expect a dollar reserve currency? Won't producers and commodity exporters want some sort of tangible wealth to represent declining reserves? I think it's a great question. I think it gets to the crux of a number of issues. If keeping oil supplies flat to up slightly requires significant, sustained, ongoing increases in oil prices, which is really what we're talking about when we talk about peak cheap oil, then a nation would have to be blunt, either an idiot or afraid of being invaded by the U.S. To hold their national wealth in treasuries, yielding negative real rates, which is happening now, but in particular, holding it in treasuries when peak cheap oil means those treasuries mathematically have to buy less oil every single year on average permanently. Or at least until you get prices high enough that you can significantly ramp up oil production. This is a problem in particular for Europe, China, Japan, South Korea as well, which are creditor nations or regions that are also major oil importers. And so you can't, those nations can't hold treasuries that lose 7, 8, 10, 15% of their value against oil every year, because pretty soon they're going to have a currency crisis because they won't have enough, the real wealth of their country relative to the critical import of oil will evaporate in not too long a period of time. To me, that then, to address your question, is that it means these energy importing creditor nations and regions are going to be highly motivated to shift their FX reserves out of treasuries, out of sovereign debt more broadly, into wealth assets that can rise to preserve oil purchasing power. Gold is really the only thing on the central bank list to buy that satisfies that. You could also make a case that the Swiss National Bank buying equities also works as well. Japanese have done a little bit of that as well, although I don't know that that's what their goal has been. So for individuals, I think Bitcoin fits that list as well. But I think that is a critical point to make in looking at, okay, what are some of the broader macro implications of peak cheap oil? Next question from MT. I would like you to discuss possible immediate catalysts for the Fed to turn more dovish and acknowledge the debt situation and its implications for policy. Will another tightening / deflationary bust cycle be needed before they get the message? I think the catalysts, the possible catalysts that are needed are already in place. You've seen the China credit impulse roll over. We have the Delta variant now. We've got commodity prices rolling over, certainly relative to recent highs. And so I don't think the Fed is ever going to acknowledge the debt situation as in we are doing QE because the U.S.'s debt situation is unsustainable and we're keeping, we're financing the government at negative real rates, even though that's effectively what they're doing. But ultimately, in my opinion, that's a key driver to what it is. And so the question then, do we need another bust? Possible, but unlikely, certainly not of a very long duration, in my opinion. And that ties into the next question from JP, which is, does the path of dollar devaluation matter as much as some people seem to think? And in my opinion, that depends on your mandate, on your investment mandate. So if you are a hedge fund or somebody who's managing your own money on a monthly basis or even on a quarterly basis, and as a lot of mutual fund investors do, it matters greatly. Absolutely, I think it matters greatly, the path of how things play out for the dollar, for what the Fed does, etc. For an investor with a lower time preference, which by the way I think is a huge advantage these days, if you can manage with a lower time preference than someone who has to manage monthly, it's a huge advantage. But if you have a lower time preference than managing monthly or quarterly, then I don't think it matters. I don't think the path of a dollar devaluation potentially matters that much. And the reason I say that is since 2018, we've had sequentially shorter and shorter big drops down and risk off, and the Fed responding rapidly, right? So it was a quarter long in 4Q18, and then it was a few weeks long, maybe a month long in summer of 19. And ultimately, then early 2020 with COVID, obviously it was very sharp, but it was very brief. We had the shortest recession on record, 2 months in 2020, as we just learned last week. And so ultimately, I think we're in the situation where the gaps from the time of any sort of risk off to when the Fed has to step in to keep the Treasury market functioning, which they have all but laid out as their new third mandate last year. Those gaps in time have to keep getting shorter and shorter and shorter from the time you have a sell-off to the time the Fed steps in. The lower your time preference, and this I think is critical, the lower your time preference. In other words, if you're not a monthly guy or a quarterly person managing to a monthly or quarterly mandate, it simplifies the decision process down to ultimately the longer your time horizon, down to a single question, which is, do I think the Fed will let the U.S. government default on treasuries or entitlements? And when I say default, nominally default, I mean we're not sending you the money, we're not paying treasuries, go away. We're not paying entitlements, go away. And that's the question then, the longer your time preference. And in my view, there's zero chance that, you can never say zero, there's very little chance of that happening. I think it's highly unlikely. I do not think the Fed will allow that to happen. And so then, again, that allows us to have a greater time preference in terms of how we want to structure how we think about things. And then the last question is from John Luke. If the U.S. completely bans cryptocurrencies, do you believe that signals the formal end of U.S. dominance, as you've hinted in past FFTT reports, or has anything changed in your view that either makes you think that banning is more or less likely? In my opinion, I continue to feel how I have felt, which is to say, I don't think in my opinion, that the U.S. can outright ban cryptocurrencies, Bitcoin in particular. Setting aside any of the mechanical technology aspects, which in Bitcoin in particular I think would be very difficult to do based on what some of my friends on the tech angle of that have told me. With that said, from the macro perspective, I don't think the U.S. can outright ban Bitcoin because U.S. dollar reserve status requires, as it's been structured since 1971, it requires a completely open capital account. However, the U.S. government can maintain a nominally open capital account and make things very difficult in the short run for owners of Bitcoin, as we've seen in the last 3-4 months. They can threaten regulatory impacts. They can, some of which might be good in the long run, quite frankly. They can do a number of things to make people uncomfortable, and we've seen that happen. And I don't think that will ultimately matter to Bitcoin in the long run, but in the short run, I think it's something you have to be aware of. So that's it for tonight. I appreciate everybody's questions. I hope everybody has a great rest of your weekend. And as always, if you're interested in finding out more about what we are up to, you can always check us out at fftt-llc.com. And if you like these updates, as always, check out our Tree Rings product every Friday, 10 most interesting things. Try to tie together a number of dots in a very unique manner, and we get a lot of great feedback about that. So everybody have a great rest of your weekend, and we will talk with you soon. Take care, everybody.